Everyone, Jason here with buyfi.ca, group created by investors for investors. I wanted to talk today about a very common misconception that new real estate investors have about investing in real estate. And that is that the profits generated by investing in real estate comes from the appreciation of the properties that they buy. It's easy to see why people think that. That's very common to see a property increase fairly substantially in value. And a lot of returns have been generated from the appreciation. But if you talk to most savvy investors, that's not their primary objective when they're looking at investment properties. If you've come from a background of investing in things that require an increased value to generate a return, say you've in the past you've bought gold or diamonds or artwork, or even stocks or bonds to some degree, or cryptocurrency. The intent is to buy today and sell tomorrow at a profit. Unfortunately, if that commodity or that asset doesn't go up in value, you're stuck with a loss or no profit at all. And that theory is called the greater fool theory. The greater fool theory states exactly that, is that someone intends to buy something and sell it to quote-unquote a greater fool for an inflated price or for an increased price in the future. And of course, everybody that's investing in something that wants to sell it in the future for a profit is convinced that they're not going to be the greater fool. Someone bought that item and doubled their money on it and sold it. The next guy bought it, doubled his money on it and sold it. Now you're going to buy it, double your money, and sell it on to the greater fool. And maybe the greater fool can turn a profit, or maybe he gets stuck with something that's actually not worth what he's paid for, and he has a difficulty generating an income. So if you've come from a background investing in that type of thing, you can see that that's the assumption when it comes to investing in real estate. But if you look at the difference between price and value, it's where you can start breaking down what's speculation and what's actually calculated returns. So gold, for example, has a very high price, but it has a very low value. If you look at the actual industrial use of gold, or the actual functional use of gold, it's very, very limited. Same with diamonds. The majority of gold, the majority of diamonds is sold based on its perceived value. Even art or classic cars are based on the scarcity and the perceived value, but there's actually no intrinsic value in those things. If you're hungry, you can't eat gold, you can't live in gold. Gold's not going to drive you to and from work. It's a luxury resource that is only valued based on its scarcity and what people are actually willing to pay for it. So if you can find someone that's willing to pay more for it than you paid for it, you can generate a profit. But if someone decides that they're not willing to pay that price for that commodity, you can get stuck with it. So if you look at a company like Toyota or Microsoft, they're very well established. They have billions, maybe even trillions of dollars of infrastructure, factories, employees. They generate a product that they sell, so they're generating a form of income. There's actually a lot of value there in both assets and the ability to generate income. Whereas if you look more towards a newer company that's maybe less stable, the value might be more based on speculation of growth of that company. Say, for example, Tesla. They do have products that they sell and generate a profit, and they also have factories where they produce those products and assets to produce those products with. But a lot of the price of Tesla is based on where people think that company's going. I'm not here to tell you that speculating on where a company's going or where a stock's going or where real estate's going is a bad idea or a good idea. I'm simply trying to help people understand the difference between speculating that something's going to be worth more and speculating that you're going to return a certain percentage on your investment versus calculated returns. So if you look at something like Bitcoin, for example, there's very little value there, but a very high price. it's actually not really offering anything. People, again, can't eat it, drink it, live in it, or use it for any functional purpose. You could argue that it can be used as a currency, but there's many, many currencies out there that are already used as currencies, so it's not really offering anything new or exciting. So when you look at the concept of speculation versus calculated returns and how that applies to real estate investing, you can see that yes, real estate can go up in price and you can generate a return that way. But most savvy investors are very, very insistent that that property generates some form of income, at least enough to cover its own operating costs. So a good example of that would be if you were to buy a $500,000 house and get a $400,000 mortgage on the house and invest $100,000 of your own money, that the income generated by that property from the tenants would cover not only the mortgage, but your property tax, your insurance, utilities, property management, repairs and maintenance, cleaning, everything like that. At the end of the month, you would either not have any money left of the rental income, or you would have a bit of a surplus, a bit of cash flow. Once all of those costs are covered, you can now hold that property indefinitely. You're not reliant on that property appreciating to actually generate a return. An example of that would be that exact house for $500,000 that you invested $100,000 of your own capital into. And 25 years later, you've paid off that $400,000 mortgage using the rental income to do so. Now, if that house in that time frame goes from $500,000 down to $250,000 in price, that's a pretty substantial loss and not very common in the real estate world, especially over a 25-year window. But the nice thing about real estate investing is you've actually still generated a profit, because you paid $500,000 for that house, but you only used $100,000 of your money. $400,000 came from the bank, and the tenants are the ones that paid back the bank. You now have a $250,000 house and you sell that house. You've actually still generated $150,000 profit by paying off the mortgage. So you bought for $500,000, you sold for $250,000, but your initial investment out of your own pocket was only $100,000. So you've actually still generated a return. And you can see how speculation, if you get it wrong, if your numbers are all based on something increasing in value and you get that wrong, you could see no returns at all or a substantial loss. When it comes to investing in real estate, if you focus on cash flow and debt pay down and not so much the appreciation, you can save yourself a lot of headaches and a lot of lost money. And again, real estate typically does appreciate, but it's nice to know that even if it doesn't, you're still going to see returns. You're still going to actually generate a return on your investment. And that's why many investors will only invest in cash flowing properties. So that's just a quick video to kind of explain the difference between investing with calculated returns, understanding that if you know the income of the property and you know all the expenses of the property, you can calculate with fair certainty how much profit there is to be made on that property, even without speculating on appreciation, and how the appreciation can be the icing on the cake. If you're buying something specifically to see appreciation and it doesn't appreciate, that's really out of your hands. There's nothing you can do about it. So that's my favorite aspect about investing in real estate, is the certainty that as long as I've run my numbers correctly, I'm going to generate a profit of some sort. That's really important to understand. So hopefully that made sense to you, and hopefully no one out there ends up being the greater fool. See you next time.